Welcome to the Chesalbridge Capital Market Observations Call for Monday, July the 17th. I'm your host, Eric Jefferson. I have some big news on the inflation front, some data that we got last week. That will be the focus for today's call, going through those numbers, outlining what it may look like and mean going forward. For a more in-depth take on our current views, I encourage you to take a look at a recently published market commentary that recaps everything that took place with respect to markets and the economy in the first half, provides our thoughts and our views on what could play out as we now get into the balance of the year. Before we get started, though, I have a few quick words from our legal team. With that, we can go ahead, dive right in. As I mentioned, got some very encouraging news on the inflation front last week. That gave the market bulls all they needed. We saw stocks rally over 2%. Following the Consumer Price Index, that is CPI, the most widely accepted measure of inflation, that increased 0.2% in the month of June, up on a trailing 12-month basis or year-over-year rate of 3%. That is the smallest annual increase we've seen since March of 2021. Just to put that in context, the annual or the year-over-year inflation rate peaked in June of last year at 9.1%. So over a two-thirds decline there. Obviously, a lot of encouraging news. A big drop, though, really had to do more with June's figure rolling off. So inflation can be tracked month over month. One of the challenges there is that doesn't necessarily incorporate different seasonal adjustments. So if you consume less oil in the spring and fall months as opposed to summer driving season and in the winter where you're heating your home, that can impact supply and demand metrics of oil and possibly adjust those prices in a way that may not be meaningful of the overall market conditions. The trailing 12-month or the year-over-year change, more widely accepted, used as a way to gauge how have prices performed over time. That is the Fed's 2% long-term average. When we talk about those goals, that is the focus. And as I mentioned, CPI in June of 2022, that figure was up 1.2%. So where this year's June number came in, 0.2%, that accounted for a 1% roll off right off the top. Again, that progress isn't necessarily set to continue as we get further into the balance of this year. When we think about the importance of inflation, going to feature that in next month's Asking for a Friend. We actually go through and quantify what the diminished purchasing power is over the course of several decades based on different inflation scenarios. Again, that's why that long-term average of 2% is very important, but more importantly, so is planning for changing conditions, because certainly, particularly in years like we've experienced, that number can take a big bite out of paychecks, particularly people on a fixed amount. Now turning to markets, last week kicked off earnings season. That's where we hear from corporate executives, give an update on how their companies did, provide guidance going forward. As they historically do, that began with a lot of the big banks. We heard from Jamie Dimon of JP Morgan. He confirmed consumers still in really good shape, are continuing to spend, depleting what have been excess reserves built up throughout COVID rather. They're about 50-50 on whether or not we do actually go into recession. But one point that he highlighted that's been reiterated by a lot of other firms is that not all recessions are created equal. All things considered, if we were to go into one, which still very, very likely, where there's not as much leverage, there's not as much excess in our economy, in theory, that would lend itself to the notion of having a shallower or not as severe recession if a slowdown should occur. As we think through the earnings, what else we've heard thus far, very, very early on, figures have been better than feared. Unfortunately, though, not all good news. Currently, the macro expectation is for earnings to be down roughly 7%. That represents one of the largest year-over-year declines And that's especially interesting when you think about the fact that the S&P 500 has moved in the other direction year to date with now double-digit gains. What's really driven that has been sentiment versus fundamentals. And so the best way to illustrate this, I shared this example recently. If you think a asset, the fair value is $100, you typically wouldn't pay 105 for it unless you were convinced that it was going to 110. If you can sell it for more than you bought it for, in that scenario, even if you're overpaying relative to what that fair value or that fundamental value is, there's still profit to be made, and so likely to still move forward with that trade. If you think, though, that the market will be flat or potentially negative, certainly in that scenario, you would not overpay for an asset if you expected the chance of losing money. And so the major concern with markets today is they are pricing in, or they are in essence saying, we are convinced stocks are going to 110, and so we're going to continue overpaying for them relative to fundamentals, just because do believe there is a case where we can be rewarded. The challenge, though, and certainly not impossible, if inflation does come down, if unemployment remains muted, if our economy is able to sidestep the 500 basis points of rate hikes that's been jammed down its throat, there certainly is a scenario where stocks can move to that 110 hypothetical rate. The concern, though, is if they don't, if there is even the slightest stumble that suggests 110 is now no longer a viable target, let's say they are flat or even negative, in that scenario, you've now overpaid for an asset that's worth less than its original fair value amount. That's where you can start to see some more violent downward swings, again, if that perfect scenario getting us to the hypothetical 110 doesn't play out. Hopefully that makes sense. As always, happy to discuss in more detail. If you don't connect, have a great rest of the week. Take care.